Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here, alongside co-host Mr. Jay Stubbs, the Director of Risk Management for Providence Partners. Jay, how you doing?
Josh, doing great. Good to be with you here in studio. It's steamy and warm out there. Been doing a lot of junior golf. For those of you that have kids or grandkids on the golf courses, Jimmy Green Tour is alive and well, working hard. Got 2 more events coming up, but gosh, it's been fun. Good summer. A little bit of travel, a little bit of work, and leaning towards a lot more work now.
Yeah, summer on the Gulf Coast. A little steamy down here. All right. Well, we are back here in Coastal College's recording studio. We're beautiful downtown Fairhope. And Jay and I hope to put together another great show for those of you tuning in. Listeners, Jay and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you. Our first segment, we're going to do a deep dive on the topic of the day. Second segment, roughly 30 minutes past the hour, we're going to have headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Joshua's Crystal Ball and Big Mouth. Buckle up, we got a lot to get to. Quick background on me, for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, and that's a revised website. Did you see the new website, Jay?
I did, Josh. Yeah. You guys did a good job.
They did a great job,
and
yeah.
I noticed a lot of good commentary. If you're listening, walking around at home or driving around in the car, check out GulfCoastFA.com. That's great site.
Yeah, thank you. GulfCoastFA.com. Thank you to David Cooper for getting that site going for us, and Trish and everybody that helped. Or you can give us a call, 251-327-2124. And if you just missed that contact info, don't worry. We're going to repeat it several times throughout the show. Speaking of the show, so Jay, I got to be honest with you. You're the first person, and maybe just because I wasn't paying a whole lot of attention, but you introduced the term the retirement red zone to me. So full credit there.
Thank you.
I don't think you coined it necessarily.
I did not coin it, Josh. It actually came from about 20 years ago in the variable annuity space. One of the variable annuity representatives for, I believe, Prudential.
Okay.
Prudential came in and they actually built a marketing campaign around that. Clearly, the Prudential team wanted to promote their product, and they said, hey, we've got the retirement red zone marketing material for you to use with your pre-retirees. I thought it was a great concept. I don't think they use it anymore, but I've continued to use it because it makes a lot of sense. And if you're any kind of a football fan, you understand what the red zone is.
Yeah, first, a lot of football fans down here. So, well, and, I don't know if you noticed, but it gets used a lot more. So for those of y'all that are not familiar with it, basically what we're talking about is if you're within 5 years or less of retirement, right? You're in the retirement red zone. And Jay, for the point of this episode today, I also want to kind of talk about the first 5 years after retirement.
Right.
So we're going to do 10 years, or 10 yards, if you will, the retirement red zone. And the reason is that it's so important is in this 10-year window, all the financial decisions that you're going to make are very amplified. It's different than when you make a mistake in your 30s and you've got another 20 or 30 years of earning power to recover from it. When you get into the retirement red zone, everything needs to be very accurate and done very well. So that's what we're going to talk about today. We're going to talk about the retirement red zone checklist. Now, as I was telling you, Jay, the term gets used a lot more. If those of y'all listening, if you're not driving, obviously, if you Google retirement red zone checklist, you're going to find kind of a surprising number of checklists. So what I want to do is, opposed to just kind of, hey, we're going to read through some generic retirement checklist, I want to give you all, we're going to cut through some of the cookie cutter stuff you'll see on these lists, and we're really going to get more to the structural things that Jay and I deal with. Honestly, the hundreds of people that we've worked with, we're going to have a little bit more practical application here. So what I'm going to do is I'm going to list out what is a checklist item for those of you in the retirement red zone? And again, we're talking about 5 years or less to retirement, or potentially you're 5 years in or less in retirement. And honestly, this topic applies to everybody, but it's just going to be especially critical to you all in that red zone. So you ready, Jay?
I'm ready, Josh.
So the first item we're going to talk about is expense tracking. This is, in my opinion, this is the number one thing that is going to help determine, at least mathematically, how successful of a retirement that you have. And let me set the table for you, Jay. So if you, in most generic retirement red zone checklist, you're going to see estimate your retirement expenses. And I want to talk to you all why estimating is kind of a flat out trap, if you will. This is not a game of horseshoes. The goal is not to get it close. The goal is to get it pretty accurate. So a lot of times when people estimate what they spend, sometimes they're just using wishful math. They'll look at their mortgage payment, their utility bills, they'll look at car payments, maybe they'll add a little bit for groceries and eating out, and they'll say, we live on $6,000 a month. But what they kind of ignore are some of the things that hit you call them friction expenses, if you will. You got the $1,200 annual insurance premium. You've got the AC, the air conditioner goes out, which happens. I'm sure our AC people are very busy right now.
I already had a fan motor go out this summer.
Right. You got kids and grandkids. You got all this stuff that adds up. So let's talk about that.
I think this is great because it is a lost art to track expenses.
Whether
you're a 20-year-old, 22-year-old graduating from college, going into the workforce, trying to figure out, can I do this apartment or this house or whatever, all the way to the retiree saying, can we afford to go on this vacation, or do we need to kind of save some more money? I think tracking expenses is a lost art, and you need to have the reminder of get a pencil and paper out and a dang yellow pad and just start going through your accounts, and if your primary bill paying account, if you will, and list out everything. Don't just do it on a monthly basis, because you just said, Josh, some of those insurance premiums might be quarterly or annual or semi-annual, and you forget about them if you're just looking at your one-time monthly statement. I think it's a lost art. I think everybody should do it. Heck, I should do it. It pains me to know the outflows as well as with 4 kids and one in college and 3 still in high school, so it can be a little painful. But knowing where you are, that which gets measured, also gets results and impacts to it.
Well, especially for any of you all that are self-employed business owners that, say Schedule C, or you got a K1 or whatever, you've got a business profit and loss. If you're getting into the retirement red zone, if you haven't done this already, you need to have a personal profit and loss statement. And Jay mentioned Yellow Pad. Obviously, a lot of you all are aware of the generations now that are fairly adept at Excel. That's pretty handy. And then for those of y'all that use QuickBooks or use some type of tracking program, it's really important to download those transactions, allocate them properly, and then see where you're actually at. Because the one thing I can promise you, I don't know if you agree with this, Jay, but generally speaking, well, not generally speaking, pretty much every time, people underestimate how much they spend every month. Right.
Absolutely.
Yeah, it's rare, and there's a couple of times when we're doing the initial meeting, it's one of the questions I'm going to ask, at least to kind of get a feel. And depending on what you say and some of the information I'm gathering, we're really going to kind of dig into that, because, again, we're going to talk about retirement red zone checklists today. But in my opinion, if you don't have a very accurate handle on what you're spending every month on average, and again, do it for at least 12 months so you accommodate for those once a year or once every 6 months expenses. If you don't have a handle on that, it's going to be really hard to have accurate projections around distributing income in retirement and all the things that go into it. And the chances of you having catastrophic mathematical failure of your income plan are pretty high with that. So
yeah, and we do a good job of this in our specific industry of the life insurance world. When people say, I don't know how much I need, what do you think I need? We first sit down and say, let's do a life insurance needs analysis, a needs calculator. Your largest items obviously go in the expense category. What is your surviving spouse going to need in the event of a premature death? And then we kind of back our way into we write down numbers among several different categories. We get to a lump sum amount that's going to be needed, and then we back our way into an income solve from that lump sum. Same thing can be done in the retirement portfolio, Josh, and I'm sure that if somebody gave you all of their data, you plug it into your financial planning software, and it's well organized and spits out a plan, correct?
That is 100% correct. Yep. So then, all right, our number two item, this is going to be for those of you all that are going to be able to retire, quote unquote, a little bit young. So it's kind of the next major blind spot on any generic checklist, and that is researching your Medicare options. You know, your Medicare options are great if you're retiring at age 65 or older, but what about all this massive wave of people that are getting to the retirement red zone and are retiring before age 65, you know, say you're 60 or 62. Now you're looking at a multi-year gap where maybe you no longer have employer-sponsored health insurance because you can't carry it with you, but yet you're not eligible for Medicare. This healthcare bridge is, a lot of times, it's one of the single biggest financial hurdles for early retirees. Have you seen that much, Jay?
Josh, I had a conversation with a lady on the way over here, mid-50s. She's married to her husband who is retired on Medicare. Clearly, she is younger than him. No big deal on that, but she does not have any coverage because she quit her job to take care of him because he's had some issues going through surgery. I think it's back related. I didn't get into, I don't want to spill the mystics on what it was.
Right.
But she said he'll be good in a couple, 6 to 8 weeks. I said, great. What? She goes, and when I quit, I went on Cobra. So she's got her Cobra Healthcare insurance premium. She knows what that is for the next 14 months. She's worried about month 15 from now.
Right.
What's that going to look like? The marketplace is not very affordable. What are my options? So I had to walk her through some things that she could look at and explore for. And what right now she's considered a sole proprietor gig economy worker. She's doing independent contractor type work. She doesn't have a full-time job, and she says, am I going to need to go get a full-time job to protect my own health care insurance from now until 65 when I can go on Medicare? Just a real-life example of a gap that this lady is experiencing while her husband's at home on Medicare sitting, doing just fine.
Well, let's talk about the different options. And so you mentioned Cobra. I believe Cobra is a max of 18 months.
Correct.
So she's been retired for a little bit.
Well, she has been, she quit her job. She didn't retire. She just quit to take care of it at home.
And for a lot of you folks that have actually used Cobra, you probably realize that sometimes it's a little bit of a shock, the premium, because, especially if you've been used to a regular paycheck, and let's say you were saying, $200, $300, $400 per month coming out to cover your healthcare costs from your part of the expense, but you didn't see the $1,000 or $1,200 or more that the employer was paying. When you go on Cobra, you're paying the entire amount, plus I believe there's like a 2% fee to go on Cobra, generally speaking. So you're talking about something that may have been costing you $200 a month, now jumping up to $1,000 or more per month on Cobra. Is that kind of what she's experiencing a little bit?
She said she's fine with that. She can manage that Cobra for herself, but she said she started pricing out in the marketplace, and it was just not going to be, it was going to be 3 to 4 times more than her Cobra. So I encouraged her to look at sole proprietor. As a sole proprietor, there's one of our insurance companies in the state of Alabama named Alpha.
Okay.
AlphaHealth.net is a resource that your listeners need to be aware of. It was designed a couple of years ago for farmers specifically, Alpha being the farmer's insurance choice in the state of Alabama. However, they designed it for sole proprietors, entrepreneurs, business owners that have, small business owners. You have to go and qualify now. But she qualified as a mid-50s sole proprietor, gig entrepreneur, and could probably go get some coverage through Alpha, and it's going to be drastically less than the marketplace.
Very good. And then you did mention the marketplace. Sometimes depending on how your income is counted, if you go to the ACA marketplace, you can run through an exercise where you see if you qualify for any tax subsidies. Now, I don't actively do health insurance, but I am familiar with the marketplace, and you can take a look at how those subsidies, if it's worth it to the plans that you can pick. I can tell you that just having seen some clients go through it, you're kind of guessing at what your income is going to be, especially for those of y'all that don't have a quote unquote steady income. And then at the end of the year, whenever you file your taxes, if you've gotten close to that estimate, then you're going to be probably in the same ballpark of whatever the subsidy was. If you underestimated your income and you made more, then potentially you might have to pay some of those subsidies back. And on the reverse side, if you overestimated your income and it's lower, potentially you qualify for more subsidies. But I do know that marketplace has had some turmoil here in the last several months, right?
So that's a nice word to give.
Yeah, it's a non-political kind word there. The point being is, this is definitely one of the things that you want to have some answers for before you running into retirement before age 65, and we can definitely help with that. Okay.
And that also lends itself back to number one. That's an expense that you need to track.
Yeah, because that expense that was $200 a month is now $1,000, and now you've got a significant increase on a line item. Very good. All right, retirement red zone checklist item number 3. This was one of Jay's favorites: care, custody, and control, account consolidation, and quote unquote decluttering. So a lot of times we'll sit down with folks that are in retirement red zone. They'll have, an IRA at one custodian. They'll have a 401k at a record keeper. They'll have some orphaned 401ks from previous employers. They'll have an inherited IRA on a brokerage account, so on and so forth. They got accounts everywhere.
Now we're at 5 accounts.
Yeah, and that's not uncommon. And honestly, it's not a terrible problem to have, but the problem is you don't actually know what your overall asset allocation is because the money's spread across those. And a lot of times if you run a study on it or if you aggregate them, you can find that a lot of times people own the exact same overlapping mutual funds in all those accounts because people tend to kind of invest in a similar manner across the board. So consolidating those, especially if you got some, if you're putting qualified money with qualified money and so on and so forth, it's going to accomplish a couple things. One, it's going to make administration of your investment accounts a lot easier. You're not tracking down 5, 6, 10, 1099s at one time. And secondly, it allows us as financial planners to help you build a precise withdrawal strategy where we're not just guessing at where things are at in these different accounts. So Jay, tell us a little bit of experience with that when you're care, custody, control of trying to get somebody getting control of all these different accounts.
Yeah, so the biggest thing that comes up is, and especially for retirees, is their RMD. Now, this might be for the retirement red zone person. That's something they need to be aware of. But the RMD is not going to happen until they hit their 70s.
But we're going to talk about this. There's going to be some pre-planning around that. Item number 5, actually.
It is a headache when you have multiple qualified accounts trying to figure out from which account you're going to take your RMD. Yep. I am a big fan of, again, get a pencil and a pad out or an organizer and write your accounts down for you, for your spouse, those accounts that you might have that are kid, so it might be 529 or uniform gifts to minor accounts. You just write everything down. And yes, it might be with several different providers or record keepers, but knowing where things are is extremely helpful and beneficial. And that includes insurance policies, Josh. That includes cash value life insurance. That includes regular life insurance, term life. That includes your disability, long-term care contracts, all of your financial affairs. I talked with a physician yesterday. He said, I have a dedicated Gmail email address that is XYZ123, whatever. It is labeled finance, and all items of finance go to that account. And my wife and I both have access to that. So if something happens to me, I'm incapacitated or I die, then my wife gets all of that information. She's got access to that email. I thought that was a great idea. Just some way to kind of pull it all into one funnel, and so everything's kind of in one email account, so to speak. Because everything's electronic, but knowing where things are is that care, and that custody component is also making sure you know who to call for what, and so that you can have that control over that asset as you age. Well,
you mentioned this earlier, Jay, and we can take what that doctor's doing with the email, which is smart. We can take that to the next level with our financial planning software. So we use a planning software called Right Capital, like your right hand. They've actually got a client portal and a secure vault where a lot of our really involved financial planning clients can put, not only are we consolidating accounts and helping them get things, if you got 5 different brokerage accounts, it's kind of hard to track. Plus, you're probably losing some purchasing power. We can help consolidate that. Generally speaking, we use Charles Schwab as third-party custodian. But in that, we can tie all this information together in Right Capital so that you have all of your accounts viewable in one spot. You've got all your documents in one spot. You can have that email dedicated to Right Capital. And, Lord help you, but if you were to drop dead, whoever needs to come in and take care of your affairs just needs one email, one password, and there everything is. So
I talked to our good friend Cam Marston, who has told me a story of some struggle that personal to him that they're having, trying to get a consolidated statement of accounts from a family member that has passed away, and it's been weeks that they are going on. He said, I'm to the point now where do I need to make some sort of I don't know,
like petition to the judge kind of thing?
He said, do I float it out there that I'm going to turn them into the state securities commissioner?
There you go. Yeah.
I was like, no, not yet.
Not yet. Oh, so he's talking about the financial professionals. Yeah. So if I had if that client was our client, our financial planning client, it would take Cam Marston a total of 2 minutes to gain access everything that they needed to see. Of course, provided legally they could see it and all that. Right?
Yeah. Just knowing where things are is the biggest hurdle and the biggest part of the battle.
Well, and like you mentioned, just having passwords to everything, including your social media, which can run amok.
Oh, that's a whole other discussion for a whole other day. That is considered a digital asset, by the way.
That's right. Yeah, very good. All right, so let's get to number 4. So number 4 in our retirement red zone checklist is stress testing your withdrawal rate, quote unquote, moving beyond the 4% rule. Jay, I don't know if you got to hear the last episode, but we did 4 scenarios of producing income in retirement. And one of those, we talked about the 4% rule and how it, the historical background of the 4% rule, how it basically took decades of stock market performance, including the Great Depression and all that, and then said, hey, what is over a extended period of stock market performance, what is the highest percentage you can take as a withdrawal of income and still protect the value, the capital value of your accounts, right?
So you're taking income and you're playing the arbitrage of
that's right.
The account over a 1 year's time is going to grow at X percent potentially.
That's right.
And I'm going to withdraw a lesser percentage of that, but I'm still in good arbitrage here because I should be making money on my asset.
That's right. And if all you do is the 4% withdrawal rule, that's fine. There's newer and better ways, again, that involve financial planning, because we used a $1 million portfolio as an example. Well, $1 million at 4% is 40 grand. And, Jay, you and I grew up in a time where if someone was making 40 grand, they could pay their bills and live a nice lifestyle.
And again, let's add in Social Security income
Right.
for the retirement red zone person. You've got to know what that number is going to be. Social Security income projections, plus your withdrawal rate. Go ahead, Josh.
Yeah, and then so with us, with the financial planning software, we've got the ability to a little bit more dynamically manage that. If there's a good year and there's things that need to get knocked out on home projects or expensive trips or whatever, those are the years we can look at. We're not just saying, hey, you have to color 100% inside of this box every single year of your retirement life, because the reality of it is what you spend, and this goes back to item number 1, knowing your expenses, what you spend every year, there's going to be a through line of all of it, but there's always going to be some surprise. Any year of any of your life, there's going to be something that comes along that is either a planned thing that's positive or an unplanned thing that's a negative, but whatever it is, it's an additional expense. So what we're trying to do is help people. We're going to stress test that withdrawal rate. And then on the fun side of it, Jay, we mentioned Right Capital. If we see that, in the mathematical modeling that we do, which obviously you got to apply some human experience and common sense to it, but if it gives us a success rate somewhere in the mid 80s to mid 90s, we're going to say, hey, our withdrawal rate that we're planning here is probably pretty accurate. But if it says that we have a low success rate, well, then we got a problem we got to address. On the flip side of that, if it says we got 100% success rate, that means you probably can have a little bit more fun in retirement than you were planning. You can probably spend a little bit more. So definitely having a conversation around your withdrawal rate is really, really important for those of you all that are into getting close to retirement.
Let's also map out the fact that people need to know from which type of account
Bingo.
are we going to start withdrawal rate.
Right.
Josh, you and I will both know, and anybody listening, all things are good when the market's going up.
That's right. Yeah.
A withdrawal rate from an increasing market performing asset is fine. What about if we have a little bit of turmoil and we're in a down market for an extended period of time and you're still needing to draw income from that? Well, now, Josh, we're selling positions of our assets, equities, ETFs, what have you, in a down market environment. We're actually selling potentially at a loss. So we're selling a decreasing asset, and that's never a good thing. I like to tell people, hey, there's a part of your asset position that would be where we take income in an up market. Potentially, there's a part of your asset position where we take income from when we need it in a down market. Yep. And that would be an asset that's never going to decline in value because of market performance. We could talk about the types of that maybe on another show.
Well, segment 2, we touch on that, so you'll stay tuned on that. And what Jay's alluding to, you savvy investors, he's talking about drawdown risk and mixing in some sequence of return risk, which are very important things you need to pay attention to. All right, Jay, number 5, and we got 6 total. The next, you mentioned it earlier, RMDs, required minimum distributions. So a lot of times when people think that when they retire, even you business owners, they think that your tax planning is complete. It's not. The 5 to 10 years before you retire, or the 5 to 10 years before you're forced to take RMDs, depending on when you were born, usually around age 73, you've got a little bit of a tax window. So if you've got all of your money or a really high percentage of your money sitting in a pre-tax traditional IRA or a 401k, you're potentially sitting on a little bit of a tax problem down the road, right? Especially for a lot of y'all that don't necessarily need significant money out of those accounts. At some point, Uncle Sam is going to force you to take distributions, which could potentially push you into a higher income tax bracket and potentially trigger higher taxes on Social Security, higher Medicare premiums, so on and so forth. So what that means is sometimes we're not a one-trick pony when it comes to Roth conversions, but a lot of times we'll take a look, we'll have a Roth conversion conversation, especially for those early retirement years when your income may be as low as it's ever going to be. Can we take some of those qualified pre-tax money, put it into a Roth, and let it grow tax-free, no additional taxes forever? And the cool thing is no RMD requirements. So what's your experience, what's your opinion on Roth conversions around that?
I love a Roth conversion, given the scenario is proper for the tax planning perspective.
Right.
I've seen them happen for as large of accounts as $1.5 million in qualified asset, taking a 10-year time horizon and whittling that down into a tax-free Roth IRA. You don't have to do it all in one fell swoop. You can do it in chunks and bits and pieces so that it doesn't impact your taxable liability for that calendar year. I will mention to those listening, whether you're driving around or walking around at home, that RMDs don't hit until age 73, until under current tax law. However, if you are somebody who is saying, I don't know what that RMD situation is, and you're 73 or older, you need to be exploring exactly what those penalties are in the event that you missed an RMD.
Oh my gosh, yeah, it's 50%. I can tell you exactly what it is.
So, and I heard a funny, I'm going to leave this segment with this number 5 checklist item with a funny. I had a fella say, I got my RMD letter last week. Talk about ruining my day. Usually those letters come out typically in January timeframe based on previous year's performance and income situation. So just knowing that RMD is on the horizon for you, those listening in the retirement red zone, that is something that we need to plan for and look forward to, even if you're just 10 years out.
That's right. All right, last item on our list, Jay. So number 6 is something that's near and dear to your heart. That is resolving any estate planning holes in your plan. Okay, so we all know the importance of estate planning, but it's not just about who gets your house or land or investments when you pass away. It's actually making sure your financial machine keeps running if you or your spouse if your spouse or somebody, your beneficiaries get that. And what we see is the biggest estate planning disasters are usually not necessarily because of a poorly drafted will. That's not great. But a lot of times they happen because the powers of attorney are incorrect or outdated, and the healthcare directives are poorly written or outdated. So think about it this way. You have a stroke at age 68. Can your spouse actually log into your individual accounts to pay the mortgage, to pay your medical care? Do you have an updated, legally binding financial power of attorney for them? Do you have all this stuff kind of buttoned up? And especially this is one that you and I have been doing this long enough. We've seen this one, not to make fun of it, but for those of you all that have not updated your beneficiary designations and maybe you're remarried, you can have a last will and testament drafted by the best attorney in Alabama. But if your old 401k still lists your ex-spouse from 30 years ago as your primary beneficiary, guess what?
She's getting it.
She getting it.
Or he.
That's right. So did your estate plan, which Jay, I've always appreciate what you say. Who has an estate? Everyone has an estate.
Every single one of you.
I'm going to turn to you, take us home on segment 1 here.
Yeah, every single one of us listening has an estate. That means something that's going to transfer to someone at our death. I do want to reiterate and stress that there are some core estate planning documents. Now, Josh, neither you are estate planning attorneys.
Thank you for making that clear.
We have relationships with lots of them.
Yes,
I am a member of the Estate Planning Council of Mobile and have been for a long time. Last will and testament, make sure your will and your directions and instructions are up to date and filed with probate. Revocable living trust, if that is something that fits your world, you might want to explore a revocable living trust, helping your assets pass to your heirs while avoiding delays and costs of that said probate court. Definitely powers of attorney for each other, husbands and wives. If one of them is deceased or divorce situation, then maybe children, oldest children, powers of attorney, so that some financial situations can be resolved. And then advanced healthcare directives, what you want the medical professionals to do with you in the event of incapacity, not being able to function, speak, all of that. Things we don't like to talk about, but gosh, Josh, we got to make sure that we've got that kind of stuff laid out and giving those instructions to our close family members so they know what our plans are.
Very good. All right. So, folks, if you look at the complete list, it's all connected. So you track your expenses accurately, which was item 1, which tells us the exact size of the healthcare bridge you might need if you retire before age 65. That's 2. We consolidate your accounts, item 3, so we can effectively manage longevity and drawdown risk and where to take money from. Then we're going to stress test that withdrawal rate, item 4. We're going to possibly look at tax strategies like Roth conversions in item 5. And then with the last thing, we're going to make sure your estate is in order with our strategic partnerships that we have with various estate planning attorneys along the Gulf Coast, particularly around directives and beneficiaries. This is how you turn a generic internet red zone checklist into a tactical blueprint. Very good.
And you do that with face-to-face conversations
Yes.
with a financial advisor
Right.
like Josh Knoll at GulfCoastFA.com.
Yeah. I had to deal with some AI chatbot this morning that was trying to convince me that the Florida Panhandle was Eastern time and not Central time, and it finally gave up because there's some things I know for certain. So
Always count on a reliable, trustworthy, real, live individual.
there you go. All right, listeners. Well, if you want to set up a follow-up conversation with the team here at Gulf Coast Financial Advisors, it's very easy. You can call us at 251-327-2124 or find us on the website. That's GulfCoastFA.com. So FA stands for financialadvisor.com. On the site, there is a button in the upper right-hand corner. It says, Let's Talk. That gives you 3 flexible choices to get on my calendar. It can be as simple as a 15-minute introductory phone call. It could be a 30-minute Zoom, or our preference, let's meet in person at any of our 3 office locations. We have an office in downtown Fairhope. We have an office in Orange Beach, just down the road from the wharf. And then, of course, we have an office in Mobile near the intersection of Dolphin Street and I-65, and just 10 short steps away from Jay's office. So,
That's right.
Yeah, reach out to us however you do it. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we're going to give you our honest opinion about these headlines. Join us after the break to hear Jay and I discuss this week's relevant financial news in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at GulfCoastFA.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Knoll, here alongside co-host Jay Stubbs. So as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we do include the links, the hyperlinks in our show transcript, which you can find on our website, GulfCoastFA.com. Just go to the podcast tab. Just go to the episode you want to re-listen to and look for the transcript. All that said, and without further ado, let's get at it with Headlines of the Week. You ready, Jay?
I'm ready, Josh.
All right, so our first article comes from U.S. News and World Report, and it tackles a topic that probably causes a lot of you all that are in retirement red zone or maybe retirees. It's called How Inflation's quote-unquote triple whammy is Hitting Retirement Plans. So we talk a lot about inflation on the show, and we do it kind of from a high-level, nerdy CPI, math level, if you will. But most people are just focusing on what they're spending at the grocery store or the gas pump. I was behind a lady the other day at the gas station that was pretty irate that she had just spent $50 filling up her small car, Jay. And it caught me by surprise. I'm like, yeah, I can see the point. She's never spent that much on it. Okay, fine. But this piece, this U.S. News and World Report piece, highlights how a spike in inflation just isn't a single headache like filling up your gas tank. It's actually a coordinated three-prong attack on your investments. So first, there's the immediate blow. Your everyday cost of living goes up, maybe taking you to take larger withdrawals out of your retirement account and adjust your withdrawal strategy. Second, you got the portfolio impact. Higher inflation often triggers aggressive interest rate hikes from the Fed, so they can hopefully mop up some of the excess money and get inflation down. That can be rough on your stock positions. That can also do some things with your bond holdings, as we saw in 2022 when the aggregate bond market was down over 20%. Those of you all holding them know that. And then third, you got the long-term kind of eroding effect. But basically, your dollar is being intentionally debased. Even moderate inflation over a 25-year retirement can cut into your purchasing power half, 2/3, 100%. And that's really going to, especially all that are on a fixed pension or have a static, like the 4% withdrawal plan we talked about, sometimes it can make it a little bit obsolete. So, Jay, when you look at the triple whammy here from a risk management perspective, how should families protect their retirement distribution engines from getting systematically kind of eaten alive by this inflation over the long haul?
Well, Josh, you got to realize that inflation is what we call the quote-unquote silent tax of retirement. So while the market crash is loud and terrifying, so in a down situation, we hear it on the news, we hear people talking about it and grabs the headlines and makes you want to sell everything. But inflation is that slow, quiet leak in your tire.
Yeah.
So you don't notice it day to day, but 10 years down the road, you find yourself riding on a flat. So to combat the triple whammy, you got to look closely at where your retirement paycheck is coming from. Too many retirees make the mistake of putting all their conservative money into fixed rates instruments like traditional non-index annuities or CDs at the bank or fixed income bonds like you just mentioned, thinking that they are safe places. But if you have a fixed pension of $3,000 a month, like you mentioned, and we experience a sustained period of 3 or even 4% inflation, that $3,000 is only going to buy us about $1,800 worth of goods 10 to 15 years from now.
Yeah, we've seen that.
So to beat that triple whammy, your portfolio needs growth-oriented assets, things that they can continue to count on that's going to hopefully, not guaranteed, but hopefully rise and grow over time. And that's going to act as that inflation hedge. You need companies that have the quote-unquote pricing power, meaning their input costs go up, they can easily raise prices on consumers without losing business, directly passing those rising earnings back to you in the form of growing dividends. You can have a greater conversation with folks about that when they say, hey, how does that work? What types of companies, ETF strategies do I need to look at that have that growth-oriented asset and that pricing power into their company and their portfolio? Very
good. Yeah, and you mentioned some fixed interest investments and products in there. And those have their place for sure. The main point of it is that if in the old days when we were kids, Jay, in the 80s, you could sit on a pretty significant amount of cash, and I don't think you were sitting there thinking, well, if I've got $100,000 and it's 1981, it's only going to buy me $50,000 worth of goods in 1989. Now, I don't know if that math is accurate, but I can tell you that math has been pretty accurate in the 2000s. I mean, we've seen an erosion of at least 25% in purchasing power just since COVID.
Yes, we have.
Right? And we've talked about this, regular listeners, longtime listeners will know this. The biggest thing is it just comes down to math. There's nothing nefarious per se going on. It's not something where, just because somebody speaks it into existence, what is causing your dollar to devalue, what is happening is just let me more dollars. Jay, I don't know if you know this, but I was born in 75. You would have been 70.
I'm in 77.
77. So in 1975, there was about $1 trillion of what's called M2 money supply, which would be physical money plus the digital money that you can easily access. $1 trillion, right? In 2026, there is now over $23 trillion of M2 money supply. And so if you just take that alone, that kind of gives you an idea of why, since we were born, the purchasing power has decreased 20x since that time period, right?
I feel like 20 trillion of it came during COVID. That's a joke. That's a joke. That's a joke.
But the point being is you need to have a portfolio. You need to be open to some of your portfolio being in things that can hopefully stay ahead of this inflation, because unfortunately it doesn't appear that it's going away anytime soon. I know we just had a quote-unquote good inflation report of 3.5%, but that's still 3.5%. So we've got some work to do. All right. You ready for our next headline?
I'm ready.
It comes from the Wall Street Journal. Now, regular listeners know we try to avoid any sites that are paywalled. I have a subscription, but I have no idea how to pass that on to my listeners. But it was republished with no paywall on MSN Business. And it's a big warning sign for anyone that's getting too comfortable in this market. The title is called Blockbuster Stock Sales Are Threatening to Overwhelm the Bull Market. So what's going on is for basically the last 3.5 years, there has been this pretty massive, pretty roaring bull market. And for those of y'all that don't pay attention to the markets a lot, a bull means that the market is going up and is expected to continue going up. The bear side of that means that the market is either going down or expected to go down. But in this bull market, the S&P has literally more than doubled in the last 3.5 years. It's been quite a run. But as the old saying goes, stock markets don't die of old age. Instead, one of the ways that a bull market can choke itself out is when you have a tidal wave of new stock being issued, IPOs, for those of y'all that are savvy in investing, initial public offerings, or existing companies can release more stock. And when supply outstrips demand, that grinds that upward, that bull market gets ground to a halt. Here's some math behind that before I ask the question to Jay. According to this article, corporate America has already seen almost $350 billion in new stock share sales this year alone. That surpasses the totals of the last 4 years combined. And most of y'all, especially y'all regular listeners, know we had the historic SpaceX IPO. Alphabet, which is Google's parent company, it's doing an $85 billion equity raise by issuing more stock. And then, of course, there's all these different companies that are coming into the market or trying to. Anthropic, you got OpenAI, they're all trying to get in. This will be kind of a contrast because what you've seen is a contraction usually over the last handful of years where companies were buying their stock back. But back to the point of this is, for those of y'all that were investing in the late 1990 or 2000, we're not saying a bust is coming, but we had some of the same thing. There was a frenzy to issue new shares. So, Jay, when we see companies aggressively selling their own stock to the public, it usually means corporate insiders think the shares are fully valued, if maybe even overvalued. So from your perspective, is this massive surge in stock issuance a warning sign that we're in the late innings of a bull market? And if so, how should retirees protect themselves if the quote-unquote music stops on musical chairs?
Well, the consensus or opinion of that, Josh, is these types of things would be considered warning signs.
Yep.
And it comes down to the basic economic law of supply and demand. So when a company goes public or issues a secondary offering, they're essentially printing paper in exchange for the cash. When the market is hot, those investors are flush with the cash and they're happy to buy, but there's a tipping point, and that is simply more paper being printed that there is cash available to buy it. When that happens, the stock prices drop. So look at who is doing the selling. These are some of the smartest, most sophisticated operators in the world, including these mega cap tech giants, these massive private entities. If they, Josh, think right now is the absolute best time to sell their stock and raise cash, why on earth would a retail investor, especially someone in the retirement red zone, think that right now is the absolute best time to go all in on those exact same expensive equities? So that ties directly back to what we talked about in the segment one, de-risking the portfolio. In the late stages of a bull market, FOMO, fear of missing out.
And I have FOLO, fear of looking old.
You and I both have that. So FOMO is the fear of missing out at an all-time high. People see these blockbuster stock sales and they see artificial intelligence hype and they want to chase that heat and they get that bull run. But as a near retiree, your job isn't to buy at the absolute top of the market. Your job, with the help of an advisor, is to secure your gains.
Yes, very good. And I think one of the main takeaways there, because it sounds like we're talking out both sides of our mouth compared to that first article, we're saying that if you're looking at historically what has been the best hedge against inflation, and that has been, generally speaking, United States-based publicly traded stocks. And now we're telling you that those same stocks may be overvalued. The key to unlocking that door is diversification. So if you were somebody that got really excited about the SpaceX IPO, I understand that. Especially if some of you all that are ultra high net worth or maybe to get in before it actually went to the public and got bumped up pretty quick. And of course, it's crashed back to its around its IPO price. But the point being is, if you're looking at those things to turbocharge your investment strategy and your returns, history tells us that this may be the time when things have kind of reached a boiling point, but you can unlock that door through broad diversification of your investments. And you may not have all winners when you do diversification, but guess what? You don't have all losers either, right?
That's right.
All right. Well, Jay, let's do one more article before we get to segment 3. You ready?
I'm ready.
Our final article comes, and this is one that's right up your alley, so I'm going to try to tee this up quickly. It comes from Smart Asset, and it says, what is an income rider and why should you include one? So, Jay, this article talks about free steak dinner. I'm going to skip all that. I really want to get to the meat of this. According to Smart Asset, an income rider is an optional paid add-on that you can attach to an annuity that will give you a guaranteed stream of lifetime income. That's a simple explanation of it. On there, when you're looking at the quote-unquote hybrid pension, you're going to have your account value of the annuity, which is your quote-unquote your real cash, and then you're going to have your benefit base, which would be your roll-up of your income stream. So what I want to talk is, I'm going to kick it to you, is on these income riders, give us kind of a pro and a con on them. Are there fees involved with the income rider? What kind of are there guarantees on the other side? When do you see these things really playing out, and when do you see people maybe misrepresenting what those income riders actually do? I'm going to kick it to you.
It's a lot of information in a short amount of time, so we'll do our best.
Take your time. If we got to cut segment 3 short, that's okay.
Let's go back to the person that was listening that says the 4% withdrawal rate.
Yes.
If you're listening, if that person is uneasy about a 4% withdrawal rate situation, they want to reposition their asset into potentially, Josh, into an annuity product with a income rider at some point down the road that they can then choose to turn that guaranteed lifetime income on. We've seen these, the immediate income is a SPIA, single premium and immediate annuity.
Yeah, Michelle loves saying that word.
Then there's deferred income annuities.
Yep.
A lot of those are indexed based, and you put your dollar, you deposit into the annuity, or you do a 1035 exchange from an old cash value life insurance policy, or you move an asset that might be qualified currently, you move that into one of these products, because you are a candidate if you say, no, I need guaranteed income. I need to know exactly when I turn 68 years old, 72 years old, that this income is going to be a certain amount per month, per year, whatever. You can get some extra dollars with that benefit base, because when you commit money to an annuity with an income rider, the company is going to reward you with extra dollars towards your benefit base.
Okay.
Then they're going to give you some sort of interest crediting rate on that benefit base. I've seen anywhere from 5% simple interest to 7% compound.
Okay.
Different companies have different roll-up rates of your benefit base. And then, based on your age, they're going to give you a specified withdrawal rate that'll give you that lifetime income.
Okay.
All of this is in black and white. And you, Josh, I've sent you illustrations on these in the past for
Absolutely.
some of your clients. It is in black and white. It's guaranteed by the insurance company that is offering that annuity contract. And it is a peace of mind play. If some component of a retiree's retirement income needs to be guaranteed, then this is definitely an option they would consider. However, the con, there is a fee. You're going to pay a fee for an income rider on an annuity contract. I want to go back and say regular annuities, MYGAs, SPIAs, and traditional fixed index annuities, Josh, those don't have any fees tied to them. There's no management asset fee coming away from the portfolio value inside of an annuity.
Okay.
However, if they choose an income rider or potentially a death benefit rider, there is a asset fee that's charged from that account value each and every year. It ranges anywhere from 65 to 75 basis points upwards of 125 basis points, which is equivalent of 1.25%. But you are paying for the peace of mind, knowing that there's going to be income that's going to be guaranteed for the rest of your life. And if you so choose, you can make sure that that income's going to a spouse. And if you so choose, you can make sure that there's a death benefit component going to your beneficiaries from the original position or original deposit amount of that annuity that you made in the first place. So that could be overwhelming to some that are listening. Just understand, an income solution built within an annuity could definitely give you some peace of mind and extra income down the road, and it's going to be guaranteed, and it's going to be lifetime.
And you need to read the fine print.
Absolutely.
And don't let somebody convince you that it's a return on your investment. It's just an increase in your income rider.
Oh yeah, I've heard so somebody will say, oh, the roll-up rate is 7%, and then they'll say, so-and-so's giving me guaranteed 7% return. No, you're not. You're getting a 7% roll-up rate on your benefit base from which your income is going to be calculated 10 years from now. That's not guaranteed money. That is something that you actually are paying for. And again, Josh, I do want to stress, great vehicles for the people that fits them from a suitability perspective. Yep. And that's our job as advisors. You know this, to sit down with somebody and say what their wishes are. They may say, that's what I want. That's right. Exactly what I want.
Yeah, especially people that are fan of pensions, for sure. Well, Jay, we ran out of time for segment 3. Man, we had a good prediction around inflation and interest rates, but we'll catch it next time, because unfortunately inflation and interest rates are going to be on everybody's mind for a while, all right?
Let me just say this. I do not think that the Fed and our new, as his last name is Warsh.
Yeah, Fed Chair Warsh.
I don't think they're going to be making any interest rate adjustments for the rest of 2026.
Yeah,
I'll go ahead and say it.
Yeah, I think that's fair. I think if anything, there's going to be some pressure on them to raise rates, and that's going to be an interesting conversation. But regular listeners, just stay tuned, because we'll be talking about it. Yeah, so in closing, listeners, we want to give you one last opportunity to reach out to us. If you want to set up a conversation with us, you can give us a call. That's 251-327-2124, or find us on our website. That's gulfcoastfa.com. FA is a financial advisor. There's a blue button that says Let's Talk. You can set up a 15-minute phone conversation. You can set up a Zoom, or you can meet in person, which is what we prefer. Again, 3 office locations. We're in downtown Fairhope. We have an office in Orange Beach, and then we have an office in Mobile near the intersection of Dolphin Street and I-65. Make sure you reach out to us. Well, folks, that's our show for the week. I want to give a huge thank you to my co-host, Jay Stubbs. Thanks for coming over here, buddy.
Hey, I love coming over here, especially when there's no traffic on the Bayway.
Yeah, you're right. That's pretty rare in the summer. Thank you to the producer of the show. That is my son, Peyton Null. Thank you to our show sponsor. That is Providence Partners. That's Mr. Jay Stubbs, his company, and Mr. Andy. Thank you. Thank you to our awesome radio station. That is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music. That is local band Sloth Racer. And as always, Jay and I, sincere appreciation for all of you out there that have been listening and joining us on this journey. We calculated this morning that Jay and I have done this type of recorded talking now at least 100 times together, at least.
Yeah, and we're pretty good at it.
And we've got, oh Lord, it's hard to be humble. So,
hey, if you're listening and you're a personal or professional friend or acquaintance, shoot us a text and let us know you're listening to us.
That's right.
That always makes us our heads get big.
And we appreciate getting nominated for the NAPI Awards, which we didn't win this year, but we're coming back again next year. Anyway, folks, we'd love to be a part of your journey as well. Until we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.